For the past few weeks, there has been a disconnect between the US bond markets and the Indian bond markets, probably Asian bond markets, but clearly between India and the US. What we've seen in India is a rally in the bond markets. We've seen bond yields fall from about 6.5 to all the way down to 6.3%. Today, they are a tad higher, but we have seen bond yields fall and bond prices rise in India. On the other hand, it has been the other story in the US. After a fall to 3.8% on April 2nd, the day of the announcement of the reciprocal tariffs, we have seen US bond yields rise very sharply, which means nobody seems to want to buy US bonds. On an average from April 5th to today, bond yields in the US for the 10-year have ranged around 4.4 to 4.5%, a little inexplicable considering that one was expecting that with the reciprocal tariffs, the US is on top of the game. Why are Indian bond yields and US yields going in opposite directions? Can they continue for long? To argue and understand these issues, I have with me Mitul Kotecha, the head of FX and EM Macro Strategy Asia at Barclays. We also have with us Suyash Chaudhary, the head fixed income at Bandhan Mutual Fund. Gentlemen, thank you very much indeed for your time. Mitul, first, if you can take us, what explains the rise in the US yields? Why doesn't anyone want to buy US bonds?
It's a good question. I think, look, the reality is that there has been a scare in US bond markets. Just a couple of weeks back, there was a lot of discussion about foreign selling of US bonds. There was also concerns about these leverage positions that had been built up. The basis trade was very popular for US Treasuries, as well as swap spread pressures. And at the same time, an increase in term premium as markets started worrying about inflation risk going forward. So there's a number of factors that were weighing on US Treasuries, especially towards the longer end of the curve. We've seen a little bit more of a consolidation and a bit more stability since then. Some of those market pressures have eased. But nonetheless, as you say, there is a massive difference between the performance of US Treasuries and what's happening with global bond markets, in particular, as you say, India and elsewhere in Asia. But I think, look, the Treasury selling may not be over at this point, or at least the Treasury pressures may not be over. But look, we think there are some opportunities, and our US rate strategy team have actually been long 5-year US Treasuries with the view that some of these pressures are overdone at this point in time.
Okay. Suyash, let me come to you. Would you want to add to this? Why do you see US yields rising? And as Mitul pointed out, actually everything other than US, the yields seem to be falling. I mean, German bonds are also falling. But how do you explain the fall in Indian yields?
So, Lata, one of the notable aspects of the last many years has been the so-called US exceptionalism trade that has drawn a lot of global capital. And, what is remarkable in this phase is you are seeing a global risk-off, and simultaneous with that, you are seeing the dollar weaken by roughly 8 to 10%, depending upon which index you track, since middle of January. And that is the, unprecedented thing in this move, because typically in a risk-off environment, you would see the dollar rising. So it's probably two things happening at the same time, which is the risk-off getting netted off by some unwind of the US exceptionalism trade that is leading to global portfolio managers diversifying away from US to some extent. For emerging markets like us, making the best of a reasonably bad situation, it's good news, because what it allows is for us to run monetary policy relatively more independently. So had the dollar been strengthening into this, even if RBI wanted to ease policy, it would have been difficult for them to be able to transmit the rate cuts that they would be doing. However, in this environment, RBI is able to transmit the rate cut because they don't have pressure on the currency side. That said, the RBI has a better trade-off on inflation versus growth, as the governor very easily clarified that the tariff world will lead to weaker growth, and therefore we have more leeway to act on that. So it's the combination of all these factors basically playing that you have more policy room to ease because currency is not under pressure. And the growth inflation trade-off is relatively clearer for you, as a result of which, bond yields are responding to this environment.
Okay, well, let me quickly complete this argument, Suyash. in India, growth and inflation are under pressure. Growth under pressure because of global headwinds, inflation under pressure because of an expected Chinese-led disinflation. But usually we say that unless the difference between the US yields and the Indian yields should not be too much. At the moment, there's hardly, the difference between the two yields is declining. So wouldn't that be negative for the RBI to cut?
Look, the argument is not as powerful in the current scenario because you would also remember that post-pandemic US is on a different fiscal trajectory. So the first round of yield narrowing happened because the US is now on a 6.5% kind of fiscal deficit, and India has consolidated. Many other EMs have also consolidated. So that accounted for the first round of narrowing of yield differential. The second round is what we just discussed, which is some bit of the US exceptionalism playing out, and therefore the need to diversify away a bit from dollar assets. And our sense is, that you can actually live with narrower yield differentials given the current trade that is playing globally, which is the need to diversify away into well-run other geographies which have relatively deep capital markets.
Okay. Clearly the rise in US yields is not playing on Asian central bankers. We are seeing many of them going ahead and cutting rates. Mitul, I wanted a slightly longer term view from you. What the US is basically asking every other country is that you run a deficit with me. Don't run a surplus with me. Now, if I don't run a surplus with the US, I don't get dollars from them, and therefore I will not buy US bonds. Is not the Trump administration killing any appetite for US bonds if they ask everyone to run a deficit with them? So is there a structural distaste for US treasuries?
It's a very good point. There is a structural issue here because, as you say, if the reality is if the US suddenly doesn't have large deficits with other countries, then other countries will not be funding the current account deficits, not be providing dollars to the US, and not be buying US treasuries in the same quantities that they have been. And so I think this has been a concern. This has been something that's weighed on US treasury markets. And, I think, as mentioned, the fiscal premium is also rising because clearly, when you look at the bills that are going through the Senate and the House, there is going to be a large increase in the fiscal deficit in the US. And not only about making Trump's tax cuts permanent, but there are other measures going through. So you've got so many headwinds now that are starting to weigh. And as you said, the bigger one here is the longer term structural one is, will there be enough dollars going back into the US to buy US assets if the US succeeds? And it's a big if. If the US succeeds in narrowing its deficit with the rest of the world, that could be a longer term structural issue. And look, for the rest of the world, what we are starting, or not just starting, but from a longer term perspective, we have been seeing a reduction in dollar assets. I mean, China, for instance, has been reducing its US Treasury holdings, its allocation in FX reserves for some time with US dollars. And look, I think India, I would say, is somewhat isolated from a lot of this because India, one, it's a closed economy, it's less trade driven. Two, fiscally, India is in a better position, arguably, with the consolidation that's taking place towards a deficit of around 4.4% of GDP. Borrowing requirements are fairly well constrained. Inflation has come off fairly rapidly, and the currency is stable, if not firmer. And so all of these really do bode well for further gains in Indian bonds. And I think what we've been seeing is that outperformance justified by fundamentals in India, where in the US, that hasn't been the case of late.
What's your Indian bond range or, forecast, say, by June or December, Mitul?
Our 10-year IGB forecast was 6.25% by end of this year. But look, arguably, the move in bond yields in India has been more rapid than anticipated. So it's possible that we could get there even earlier. But we have our forecast of 6.25%, and so the trend we still think is going to be for lower yields in this environment. And India's growth is still holding up better than most countries, but clearly it may be taking a hit from global trade weakness and global recession that we're anticipating. So that could also be a factor supporting India's bond markets.
Suyash, your bond yield forecast by June and December, sixth quarter that Mitul says is only 7-8 basis points away.
So, Lata, like Mitul said, things are happening fast. And, recently we have taken down our terminal repo rate forecast to 5.5%. There is a likelihood that if the global growth shock turns out to be bigger, then this could be even slightly lower. Also, I think one of the very important factors on the table is RBI is really focused on transmission of rate cuts that it is undertaking. So by our calculation, by the end of April, RBI would have conducted almost 4 trillion rupees worth of OMO purchases. Another 2.2 trillion of FX swaps have been done. So all combined, significant liquidity measures have been undertaken, not to mention that the 4 trillion of OMOs have taken out that much duration from the market, thereby creating more duration demand. So our sense is you could easily, kind of see the early sixes. That's probably a good place to work with, for the foreseeable future. All depends upon whether the dollar finds a floor soon enough. Our sense also remains that eventually the Fed will have to sway in favor of curtailing the rise in unemployment, because there may be slightly more permanency to that rather than the one-time shock to inflation. But that is an evolving scenario. So if the Fed were to really swing into action, then by definition, Indian bonds will also have that much more space to fall eventually. Although, like we discussed, on their own, they are doing just about fine till now.
Okay. Well, Mitul, I need a dollar range as well. If you can, a dollar rupee range, but more importantly, a DXY. Does it go much below the current 98.5?
Well, more broadly, we've just actually revised our euro dollar forecast, and we now have really marked to market. Our views on the dollar have been somewhat constructive, and clearly they've been under a lot of pressure. And now we do see potentially, at least in the short term, euro dollar to edge up to sort of 117-ish. And our medium term view now, which is reflective of our sort of augmented PPP fair value measures, is that euro dollar settles around 115 in the next several months. So on that basis, look, we may have seen almost the full bulk of dollar weakness, but you can't rule out a little bit more short-term weakness. What we would say is that positioning is very negative. Sentiment is also very stretched negatively. One thing that is concerning us in terms of the hit to the dollar is obviously the pressure on Powell here and what impact that has on U.S. policy credibility, certainly if he's pressured into lowering rates. So again, that's weighing on the dollar as well. So it's hard to rule out further short-term pressure. And again, as I said, we've now shifted our medium-term view to more sort of consolidation around this 115 euro dollar.
Okay. Actually, you were the first person to say 115 euro dollar when euro dollar was at 1.07. I remember that, Mitul, I think when we last met. But very quickly, just in case Powell is made to leave, I don't think that's anybody's base case because the law is very clear he stays till May 26. But if something were to happen, what's the pell-mell in the market, Mitul?
Look, I think I agree, it's a very, very low probability event. But if for some reason he is forced to step down ahead of the end of his term, I think markets would react very, very negatively to this. And it would send, in our view, the dollar sharply lower. It would probably send US yields sharply higher. Look, the front end may move lower because markets may expect expectations of rate cuts. But certainly you'd end up with a sharp move on the longer end of the curve, reminiscent of what we just saw a couple of weeks back. So I think markets certainly would not react well to a premature termination of Fed Chair Powell's term.
Okay. Yeah, and many people's forecast of gold at 4,000 perhaps will get advanced if such an event were to happen. But yes, it's nobody's base case that the Fed chairman is removed. Thank you very much, Mitul and Suyash, for joining me in this conversation. So the US Indian bond yields 10-year is likely to get very close to 6%, probably somewhere between 6 and 6.25. That's the expectation from the experts. Wrap up on Bazaar after break. Chartbust.